Good afternoon, everybody. I am Jaron Montgomery. I'm a graduating business administration major from Orlando, Florida.
Good afternoon, I'm Marcus Washington, a fourth-year accounting student from Charleston, South Carolina.
I'm Jordan Bagnes. I'm a third-year business administration student from Northport, Florida.
And our task was to complete a risk assessment for McDonald's. Now, before we get into the risk assessment itself, we want to give you a brief overview of the company and of the industry.
Again, I'm Marcus Washington, fourth-year accounting student from Charleston, South Carolina. And with McDonald's being the largest fast food retailer in the world, operating in more than 100 countries, the industry is very competitive and largely driven by market share. McDonald's, being the largest company in the industry, owns 15% of the market share by sales. And with spending by consumers expected to increase over the years, that will also translate into increased revenues at the same time, bringing in more opportunities for fraud and fraud schemes. So with the three internal processes of McDonald's being franchising, supply chain, and quality assurance, as it refers to franchising, though McDonald's outsources many of its products, they also have their own supply chain process in which it produces some of its own food products. And with their franchises, they buy from the company's supply chain process and find ways to make the process of supplies more efficient, more innovative as a whole. And the majority of McDonald's stores are franchises, so they operate largely through their franchises, and they can earn revenue by selling off the franchises and capitalizing on the royalties. And as regards to quality assurance, they can run periodic product reviews to make sure that they're meeting and aligning with their company's standards of quality, and also to ensure that the food meets the quality standards and that the service is ethical as a whole. And once we reviewed the business processes, we began to conduct common size analysis to reveal any significant changes in the financial statement items that relate to fraud. And then we assess whether the fraud risks were high, medium, or low as it pertained to the industry as a whole.
Some key industry economic factors to consider is that since this is a fast food restaurant, there's high demand for increased wages for the lower end workers. That will increase the pricing of the food. As fuel prices increase, the transportation costs and inventory costs are going to get a little bit higher, also increasing the food. And the nutritional content that they have to abide by also has to be placed on the food. It gives more concerns for customers, meaning that they're going to be buying less of the unhealthy food and buying more of the more healthier items, more costly items actually.
So once we explored the company and the industry factors, we went ahead and spoke about some key inherent fraud risks. If you take a look at sheet 6 of your risk assessment Excel document, you'll see some specific accounts that we named. We highlighted some specific accounts. There were some accounts that had a high chance for fraud. Those accounts included cash, accounts receivables, and inventory, and we will briefly discuss some of the fraud schemes associated with those accounts. Now, with cash, we've seen the possibility of cash register fraud, since employees are constantly dealing with the flow of cash due to the nature of the industry. With accounts receivables, we included fictitious revenues and anything that would inflate the revenues and also overstate the receivables. And with the inventory accounts, we spoke about the possible double counting, fictitious inventories, the manipulation of inventory documents, employee theft, inventory theft, and falsified orders. And now we'll move to the horizontal and vertical analysis and also the ratio analysis.
In regards to the finances of McDonald's for the year 2014, McDonald's failed to meet its analyst Wall Street expectations. Therefore, it has seen a reduce in sales and also a drop with its investors, resulting in closing of several stores. The result of that, with the financial statement, sales dropped 3.7%. The payroll due to the laying off of workers dropped 1.4%, and net income dropped between last year and the year before, dropped a total of negative 14.8%. In terms of the balance sheet, current assets also took a huge drop at negative 28.2%, majority of that being cash and cash equivalents at about 25%, and inventories at negative 11%. In terms of other assets, the total dropped to 5%, and total assets as a whole dropped negative 6.4%. In terms of current liabilities, it has dropped 13.3%. Total liabilities were increased 3.9% due to increasing loans for the next business venture. Stockholders' equity dropped a total of 19.7% due to investors backing out of the deals and McDonald's buying treasury stock back from the investors themselves. In terms of cash flow statement, cash used from operations dropped 5.5% to coincide with the loss from sales due to the sale of restaurants. Cash used for investments dropped 13.8%. And cash used for financing increased 14.2% to coincide with new business ventures. Next, we'll be talking about vertical analysis.
So as we conducted the vertical analysis for McDonald's, we were able to highlight just a few accounts that had some abnormal growth, or just some accounts that are usually suspicious for different types of fraud activity. So we'll start with the income statement. The income statement, total revenue did increase as far as the vertical analysis goes. Now, with revenue being such a easy manipulated account, we just want to make sure that the company ensures there is no fictitious revenues being recorded or any revenues being recorded in earlier periods. We also wanted to highlight the percentage change with net income. The company should ensure that there are no fictitious revenues occurring again and no underreported expenses. Now, with the balance sheet, cash is always one of the most common accounts that is affected by fraud on the balance sheet. So the company should ensure that there is no cash register fraud occurring, since the nature of the business causes cash to be traded between hands so frequently. And they should also make sure there is no deposit bag fraud or any skimming happening. As far as the liabilities, the company should ensure that there are no underreported liabilities and no liabilities that are being recorded in other periods. Now, with the statement of cash flows, we wanted to highlight one specific account, the other net income adjustments account. We just want to make sure that the company ensures that there is no fraudulent activity when it comes to the disclosure of what those items mean in that account. And now we will pass it on to the ratio analysis.
In regards to the ratio analysis of McDonald's, we highlighted several significant ratios susceptible to fraud. The first ratio being revenue per employee, that deals mainly with the revenues and the receivables. It experienced a very high increase, so with the market being so competitive, it's very important that they investigate for fictitious revenues as well as premature revenue recognition to make sure that they're not recognizing revenues before the services have already been completed. Secondly, you want to take a look at the current ratio, which deals largely with the assets and the liabilities. Make sure that there aren't any costs being capitalized rather than expensed. Make sure that there aren't any liabilities that are going underreported to increase the appearance of the revenues and the assets, and also double check for the double counting of the inventory as well as the assets on file. And lastly, you want to check the accounts receivable turnover as well as inventory turnover, being that inventory and receivables are two accounts that are vastly manipulated in terms of fraud. You want to double check for double counting again. You want to double check for fictitious revenues, and of course revenues being recognized earlier than they should be recognized. And then we'll go into our fraudulent financial reporting assessment.
As we look through the fraud risk and vulnerability assessment, we went through the historical fraud cases of McDonald's. From 1995 to 2001, Simon Marketing, the marketing corporation that worked alongside McDonald's, they worked along lines of their Happy Meals, the toys, marked all promotions and their seasonal Monopoly game. One of their employees, Jerome Jacobson, a security guard, started rigging the game, giving out the rare pieces, selling the rare pieces for cash. What he would do is he would bypass their security protocols, as he was the one that delivered the pieces to the manufacturing plants that would place all the game pieces onto the containers. He would take the rare pieces and he would involve his family into selling it to friends spread out across the states. That way he would conceal it by having the winners located all across the states instead of in a concentrated area. He was found out in 2001 where the grand prize consisted of a Dodge Viper. The one who received that prize outed him and the entire operation. To include Jerome Jacobson, over 51 people were arrested in this scheme.
Another method of fraud schemes includes inventory theft between employees, especially in the fast food industry, especially around a lot of food. Whenever the whole time is complete, for most food products, managers just allow employees to just eat it or take it home with them. So in regards to this, it's conducted largely by those put in places of authority, such as managers. So what managers or cooks would do, they would make an excessive amount of food products, or more than enough that they would actually need to satisfy all the customers that they may have. But what ends up happening with that is they ended up giving the inventory to employees, or employees just take it for themselves because of the excess amount of food products that's actually available. So with that, the way that they're able to conceal that is all food companies require items that are wasted to be categorized as waste on their statements. So if the managers would just add the stolen inventory as waste, that's their way of concealing it, to make it look like those items were just wasted, instead of being wasted, they were actually consumed or used by employees, whether they might be selling that inventory or just eating it for their own personal use. So in regards to actually detecting or preventing this type of fraud, the best way would be limiting only one plate of food or one dish of food per employee, and it must be consumed at the restaurant. That would be a good way of stopping the inventory theft. And in regards to red flags, if you see an unusual amount of waste being thrown out or employees walking out with bags of food, that should draw a red flag to, hey, check this employee to make sure that they don't have any inventory of the restaurant that should be categorized as waste that they may be using for their personal use. And in regards to the financial statements being affected by inventory theft, expenses go up, of course, and inventory ends up being miscounted because there's inventory that's listed as waste when in fact it's not waste, it's just been consumed by employees. And now we're going into the fraud scheme of skimming.
So really briefly, under the misappropriation of assets tab, I want you to look at the skimming portion. McDonald's did have a skimming scheme that went on in one of their restaurants. Employees were using card readers to skim the information from the customers, and they would take that information. After waiting a while, they would utilize that information to convert those card numbers into different purchases, whatever they may be. And now we will briefly go into the internal control procedures and deficiencies that we saw as we cased an on-site case for a McDonald's locally here in Tallahassee. All right, so as we did our on-site casing for a local McDonald's, we've seen a couple of different control deficiencies, and we want to highlight just two here really briefly. The first deficiency we want to highlight is blind spots when it comes to surveillance. That gives the employees opportunities to commit different types of fraud, like stealing inventory, and also gives the customers the ability to commit inventory fraud as well by stealing sodas using water cups. The second thing that we would like to highlight is multiple employees using one register. The issue with this is it's hard to track if some sort of fraud is committed and there is cash missing, since there are two people using one register that is logged into one employee, you won't know between the two who is actually committing the fraud and who actually has the cash. So that's definitely an issue. Now, two different ways you can mitigate these fraud risk is one by increasing the amount of surveillance you have to get rid of those blind spots, and also mandating and creating policy that prevents employees from using a register if they're not logged into it. And now we will go on to our conclusion of the fraud risk assessment overall for the company McDonald's. All right, so in conclusion, as we conducted our investigation, information pointed towards the fact that McDonald's as a company and the industry as a whole is highly susceptible to different types of fraud schemes, especially revenue-related fraud schemes, inventory-related, and cash-related fraud schemes.
And what we suggest be put in place are, of course, increased usage of surveillance, increased policies regarding cash registers and inventory, and last but not least, increased documentation providing transaction justification.
And that concludes our fraud risk assessment for McDonald's.
Thank you.
Thank you.